that down to the 160 plus your closing costs.
All right. Does everybody see my screen and any issues there?
Nope, good. Looks good.
Okay. All right. All right. Okay, so I may have to let a few more people in here, but at the end of the day, what we have here, this is Mike Wise. I've actually changed the company from Capstone Direct to CMG Home Loans over the last 30 days here, made the transition. And so we are a $2 billion a month mortgage company. And you can scan the QR code if you want to, so you can download all of my contact information on your phone. And I have some exciting new products that I have to offer now with this company. And so this is a super exciting one that I want to show with everybody and make sure that they learn more about it, because I think that it is something that will change, that can change people's lives here. So it's called the all-in-one product. And this all-in-one product, the goal of it is, I mean, I'm going to show, as I say stuff, it's on the screen here. It's pay down principal faster. It's saving hundreds of thousands of dollars in interest on your home loan, and still being able to access the equity in your house 24/7. And so normally you sink your money and principal into your house on a 30-year fixed rate mortgage, and you can't see it until either you sell or refinance your house. And with this program, you can have access to it 24/7 and be able to write checks or use a credit card as well. And at the end of the day, we're going to help you get more financial independence with it as well. So I'm going to go into some background just on a 30-year fix to kind of set the stage a little bit on why this is such a great program. So mortgages play a huge role in the housing market, and most people need a loan to purchase a house. They don't have $700,000, $800,000 just in cash to be able to put down and buy a house with all cash. So it's very important to have the loan process out there. And 84% of the people in 2022 finance their house with some type of mortgage, and 62% of Americans owe on a mortgage today. So it's a big, huge piece, but it comes at a cost. And the cost of that is as interest rates, and that drives the real estate market. In fact, we know that today because the real estate market is slowing down, and because of higher interest rates. So as rates move up, the housing market slows down, people's goals are delayed, and they can't get into a house, or they don't want to get into a house because of those higher interest rates. Or somebody who has a 3% mortgage today may not want to sell their house because they have a 3% rate on their house today. And the uncertainty of today, with today's interest rate at 7%, it basically plays a role in basically how active the real estate market is. And so as rates move down, the market starts to accelerate more and more, and the debt levels start to go up. In fact, one of the statistics today is that for every 1% the rate goes down, so it goes from 7% to 6%, there's 5 million more people that can now afford that house. And not that 5 million people are going to put an offer on that house, but it just shows you that there's 5 million more people that can afford that house, and it's going to be more competitive as the interest rates move down. And obviously the reverse is true as well. So as mortgage rates move up, it becomes less competitive because not as many people can afford those houses. So it is this is the mortgages is a huge piece of the business, and it occurs, the home ownership, it's during your busiest time of your life when you are paying the most interest or the most cost on that transaction. So in order to do that, what we've done, this is from the 1930s, is when we developed the 30-year fixed rate mortgage, is to lower that obligation or lower that monthly debt. We just stretch the term over a longer period of time. And so that was the 30-year fixed rate payment. And that's 90% of the loans today have a 30-year fixed rate term. In fact, we've talked about extending those out and doing some 40-year repayments as well. And so that just makes it like, it lowers your payment down, but it makes it more expensive over the long period of time. So the longer it takes to repay the debt, the more expensive it is. And it is a costly, it's one of your costly, most expensive pieces of debt that you're going to have, okay? In fact, there's $12.2 trillion of mortgages that are out there. And this is only counting principal residence, principal balance. So that's $12.2 trillion that's out there in the mortgage debt. And at the end of the day, about half of all those households will not have enough retirement income to maintain their pre-retirement standard of living. So if you can only afford your mortgage payment as you're going into retirement, 50% of you will not have the wherewithal to continue to make that payment as you go into retirement. And I've done loans for a lot of people that are in retirement, and it becomes a very, very big burden for them to pay their debts. So 70% of all of your debt is all mortgage. So it's the biggest piece of your financial picture. And so it's a huge piece of what you're doing on a daily basis is paying for your mortgage. In fact, 42% of your monthly income is servicing your mortgage debt. Okay. So again, it's a big piece. So all the rest of your debt, it is the biggest piece. And obviously it's the most expensive piece of loan that you have, or the largest loan that you have. So it is going to take up a big piece of that income. So what we want to do is take that, well, I'm sorry, let me back up here. So half of that 42% is interest. Okay. So over the repayment period of that term, you're going to consume more interest than you will, or pay more interest than you would on any of the rest of your debt. Okay. And so again, I'm just kind of pointing out that it is a big, expensive piece of your monthly debt that you have. Now, there's great things about this, the 30-year fixed rate program. We have the low down payment options, and it helps first-time homebuyers. So we have a 3% down option on a conventional loan. We've got a 3.5% down FHA loan. So all of those things, a 30-year fixed, it helps people get into their houses. But and it's been developed in the 1930s. So everybody is familiar with it. When somebody calls me up for a mortgage, everybody asks, what's your rate? They're expecting a 30-year fixed rate mortgage payment. They're not asking normally for a 15-year or a 10-year fixed rate. They're asking for a 30-year fixed because that's what they know. That's what their parents have had. That's what their grandparents have had as far as a mortgage. So it is readily available. It is a commodity. You can call up any mortgage person and they're going to give you a 30-year fixed rate mortgage. And so that is a huge, it's a huge benefit. It's a huge pro of the 30-year fixed rate payment, because it's a fixed payment. You know what that payment is going to be for the next 30 years of your life. If you keep that mortgage for 30 years, you know exactly what that payment is going to be. But it does take 3 decades to pay that loan. And normally you, as a borrower, you keep your 30-year fixed rate loan for anywhere from 7 to 10 years. And it's usually 7 years. I think it's going to be extended with the low interest rates that people do have on their mortgages right now. But basically it takes a long time to repay, and it is super, super inefficient because the interest costs are super high within the repayment schedule of that loan. So the first 15 years of that mortgage, you are paying a ton of interest on that loan. And then the second half, the second 15 years, it is mostly, it's more principal than it is interest. It's rigid because you can't take money out. So if you get a bonus or you get a inheritance, or you put an extra $500 a month towards your mortgage payment, whatever it is, once you put that money into your mortgage on a 30-year fixed rate mortgage, it's gone. You paid down your balance, but it's gone. You can't get it back unless you get a line of credit, a second mortgage, or you refinance and take cash out, or you sell your house. And so it is very, very rigid in that respect. Okay. And it's expensive. And so I've gone over the interest. The interest is a huge, huge piece of that. And I'll show you a little bit of that in actually right now. I'll go over a little bit of the interest, but I'll show you a little bit more on the few slides ahead. So let me just admit a couple people there. So today on a 30-year fix, in fact, this is a 6% mortgage that we're talking about, an $800,000 purchase price, 20% down on a 30-year fix. Your payments, total payments on this mortgage, if you made it over 30 years, are going to equal $1.3 million in interest or in payments on that loan. Okay. And let me go to the next slide. That's 73% more than the value of your home. So that 1.3 million is 73% more than the value of your home, and $741,000 is interest. So 116% of it is interest versus principal. So even if you cut it in half and you went to 3%, which a lot of people are at today, you would still pay $971,000 in payments, which is 22% more than the value of your house or than when you bought it. And you're still paying $331,000 in interest. So it's the interest up front is a massive, massive thing. And this is what I'm talking about. So during the first 15 years, this orange graph that you see is the interest. The principal is the dark lines. And so as you can see, the mortgage, the 30-year fixed rate mortgage is front loaded with interest. And so over that first 15 years, you're paying interest. And then guess what? In year 7, you refinance again into a 30-year fixed rate mortgage. And then you start the process all over again. And it becomes, you're starting and you're paying all that interest over. And I love it because you refinance and I get another loan from you. But at the end of the day, that's not what my goal is for you guys, is to pay more interest. The rigidity of this product is money flows into the mortgage and does not flow out. So it does not come out of your loan. So once, like I said before, once it goes in, it can't come out unless you do another loan, refinance, or try and get or sell your house to get your money back. Okay. The loan, the 30-year fixed rate loan, is simply a mathematical equation. And the basic variables in this are going to be your rate and your principal amount and the time of repayment. And those are the 3 simple things that we have to deal with. And my goal here is to try and change that equation to where instead of you taking that interest that we're charging you, avoiding that interest and actually saving money over the long haul of how long you own that house. Okay. So our goal, I want you to pay off that loan. I want you to pay it off sooner. I want you to pay it off faster. And that will help you to go out and either buy more properties or enjoy other financial freedoms and get to a spot where when you do retire, there are funds that are available for you, or you don't have that mortgage that is hanging over your head. So what we've come up with, and it's been in place for 18 years now, is the ability to accelerate your pay down of your principal, lower your monthly and lifetime interest without a change in your budget at all, without a dependence on lower rates. So I haven't really talked about the rate on this program, and I probably won't talk about the rate on this program. In fact, it's a little bit higher than the 30-year fixed rates today. But what we want to do is we want to talk to you about how you can gain more financial independence and get that and still have access to the equity in your house without doing another refinance. So it's giving you the ability to gain financial independence and the ability to still access that home equity if you need it without having to refinance or change your monthly budget so that you're paying more principal down because it's a 15-year fixed rate mortgage and we're shortening the term to make sure that you pay down that mortgage faster. So let me go into it. It's the all-in-one loan, and the all-in-one loan, it takes your home loan and it combines it with your personal banking. So we put the two together. There's a checking account, a online banking, mobile banking, client services, 24/7 ATM access, a Visa card, everything that you normally have today in your checking account. We still have that with this product. You can still pay your bills from this account, and it is no different than what you're normally doing today. Let me just tell you, I'll start with the checking account. The checking account normally with you guys is your birthplace of the net worth. And what I mean by that is that's where all your income goes through. Every time you get paid, it's a direct deposit into your checking account. And that's where all of your net worth goes to. And in fact, over time, in 5 years, in 5 years, more money goes through your checking account than is typically owed on a home loan. So that's how much money, if you were to have a $500,000 loan, there's more than $500,000 that goes through your checking account in 5 years. So this is where all of your money flows through into these accounts, and it stays there for weeks and sometimes months on end before it's needed. Unfortunately, the deposits, they don't earn much interest, if any at all, while it sits in your checking account. Some of you have other accounts that you have investments in. All I'm talking about right now is your checking account where all of your money flows through. And so the money comes in, you actually, well, let me go through this here. So the money comes in, we combine your mortgage with your bank, and we sweep the mortgage sweeps your bank account every single night at midnight and takes all the money that has been deposited into your bank account and puts it back into your loan. So until that money is used to pay for your expenses. So what we're doing is we're taking that idle money out of your bank account, out of your checking account, and we're paying down your mortgage for a period of time. Okay. And what happens is that we charge you interest daily on this loan. So rather than an amortized loan, a fully amortized loan, we charge you interest, and it's calculated every day. So it's daily interest. So what we do is we take your nightly balance times the interest rate, divide it by 365 days, and that's your daily interest. And then what we do is we mark that for day one, we mark it for day two, we mark it for day three. So every day it's a different amount. Okay. And then on the following month, we take out your interest payment on the 21st of each month. So we're keeping that money that you're keeping in your account for an additional 20 days before you have to actually pay the interest payment. And then when you pay the interest payment, it comes out of your bank account, and we do it all over. We do the same thing on the next month and the next month and the next month. And so all you're paying on this is the monthly interest payments, because what we're telling you is this is a principal first mortgage, and lowering that principal in the interest payments means faster payoff and the equity gain in your home. So sweeping that account actually helps you save a ton of interest, and you're using the money that is just idle in your checking account on a monthly basis to pay down the principal for 5, 10, 15 days, as much as you can, until you have to start to pay your utility bills, your car payments, whatever it is that you have to pay on a monthly basis. And then you write those checks out of your bank account, and the money, it starts to go up, or your principal balance starts to go up, but it's there for 24/7 for your expenses. So it's there all the time. If you want to go out to dinner and you want to use the Visa card on your all-in-one loan, it's tied to your bank account, it's tied to your checking account, but you go out, excuse me, and you go out to dinner and you swipe the card for your checking account, and it will take the money out of your all-in-one loan at that point in time. If you have any other monies that come into your account on a monthly basis, then it's going to sweep your bank account every single night and take the money out of that account and use that money. But again, I want to reiterate that you have 24/7 access to you have 24/7 access to all of those funds in your account. So again, the Visa card, the personal check, the online banking, mobile banking, it's all there for you. All you're doing is taking that float money out of your checking account and putting it towards your mortgage to pay down the balance on your mortgage. Excuse me. It is technically a first lien position line of credit, and so you have access to that money for a period of time. In fact, excuse me, you have a line of credit for that amount for 10 years, and you can access that money on your account for the first 10 years of the loan, and you can pay down that principal at year 10. It's a 20-year credit reduction period. So every month, the line amount goes down by 1/240th. So there's 240 months remaining at year 10. And what we want to make sure is that you actually pay that mortgage off in 10 years. And so, I'm sorry, in 30 years. So you don't have that debt outstanding at the end of the year. So for example, on a $640,000 line, you have $640,000 available for the first 10 years. And then at year 15, there's 480, year 20, there's 320, year 25, there's 160. And then at year 30, you're paid off, just like a normal loan. But the great thing about this product is that it gives you flexibility. And the flexibility is you can pay it down. So in this example, you pay down the principal, but then by the time you're paying down the principal, college costs start to come in and you write a check for the tuition. I know that I've written some big checks for tuition, and so the costs go up. You actually pay down the amount again, and then you can pay it off, and you can have no payment or no interest for a period of time. And then let's say that you want to go out and you want to write a check for a new property. Then you go buy a rental property. You write a check for a couple $100,000 for a down payment on a new property, pay it off. And then, by the time you're in 25 years, you're old enough to have medical expenses and your body starts to break down and you got to pay for those items. And so that's when you have medical expenses, and then you just go in and you pay it off. But this is the flexibility of this product. It allows you to get to that equity that you created yourself on this product. So what we have is a simulator, and I'm going to show you kind of a result of the simulator in just a second. But this is an online simulator that goes over how you can save this money. And I can go over a couple of examples if we want to in just a minute. And so in this example that I'm talking to you about, this $640,000 loan, we had a 30-year fixed rate, and I'm pretty sure this was at the 6% interest rate. They paid the $1.3 million in total costs or expenses, so payments and interest on the all-in-one loan, and it took 30 years to repay that off. And normally people refinance in the first 7 years because interest rates go down and they start the most expensive process all over again. On the all-in-one loan, without changing any of your habits at all, without increasing the amount of payments that you have to pay it down faster, you save $273,000 on this loan, and you pay it off in 15.8 years rather than 30 years. So this is the, like, the magic is right here, is what you're looking at, is that 15.8 years. Imagine paying your house off in less than 16 years without really changing any of your monthly habits. Okay, we can go in and I'll look at some of the rate assumptions and buy the pay down summary for you in just a second. Some of the features, basically we have a QA check prior to closing. So we have counselors that actually call and go over the program with you one more time to make sure that this is a product that you want to take. And we send out a packet to you that goes over the whole all-in-one product as well. And so there's a phone number that you can call or questions, or you can always talk to me about it. And then the account activation is usually 2 to 4 weeks after closing. And what happens once we close the loan, then within 2 to 4 weeks, you get your ATM card, you get routing number, account numbers, your online portal, all your credentials and the mobile app and everything, just like you normally have today on your loan. And I'm not going to go over this too much, but a couple of the things that you need to know about. We follow the Fannie Mae underwriting guidelines for the most part. You have to have reserves of 10% of the line amount. So if you had a $500,000 line, you would have to have $50,000 in reserves. Debt to income ratios are a little tighter on this program. So it's not as forgiving. It doesn't go up to 50%, and make sure that you have a 43% debt to income ratio. And we can use asset depletion for income. So asset depletion, that gets a little bit into underwriting talk here. Asset depletion is basically if you have $1 million in your account and you don't have as much income, then we can actually use 120 months. So we take the $1 million and divide it by 120 months, and that's what your monthly income is, and that's what we can use. So there's some non-warrantable condo guidelines. I'm not going to go into some of those issues there. It's based off of a 1-year adjustable mortgage. We did have a 3-year and a 5-year fix, but they're basically, those are on hold for right now because of the banking crisis. And so we're strictly limited to the 1-month adjustable. It's the index is the 1-year constant maturity treasury. And the historical average is right around 2.1%. But right now, with what's going on with interest rates, it's like right around 5%. And so it's a little bit higher than normal. And that has had a little bit of impact just on the amount of interest that people are paying on this loan. But people that are getting loans right now are still paying a higher percentage rate, 7% right now anyways. And the margin, so it's how we price the loan is the margin plus the index. And so generally the margin on the loan is 2.5 to 4%. Right now, we're at 3 to 3.5% is what we're charging over the 1-year constant maturity treasury. So it is a first lien line of credit. It comes with a checking account, ATM. It is the normal process that you have. You don't change a thing in your day-to-day life. And it's basically using those income dollars way more efficiently than you would on a traditional 30-year fixed rate loan. So it's designed to lower the cost of interest over the long haul and to save you money and to put you into that greater financial independence over time. So this is a way different product than the regular 30-year fixed rate mortgage. And so I would like to open it up to any questions that you guys might have. So if you want to unmute your phone and ask any questions, you can. And then what I'm going to do is if you have a few questions, let's go over those right now, and then I'll go over another scenario with you. Does anybody have any questions? Okay. So what I'm going to do here, and if you do have questions, then we can look at that. And so I'm going to stop sharing real quick. And oh yes, Mr. Shukla, what question do you have? Let's see here if I can take you off. Oh, are you there, Mahul? Will you unmute yourself, Jessica, and see if I can hear you? No, I can't. Hold on.
Nope. Hold on, please. That you have. So it's going to be the checking account that you have that's set up with your mortgage, and we'll do that for you. So if you have if you currently have a direct deposit into your current checking account, what we're going to ask you to do is you take that direct deposit and change it from your current account and put it towards your new account. So if you do have, let's see here. Yeah, if you do have a question, go into that meeting chat, and I will make sure that I look at that meeting chat. So if you have any questions, type them in there, and we'll get it squared away. So let me pause my sharing real quick and stop sharing. And then what I'm going to do is I'm going to go into a simulation. And so this is something that I'm going to show you that you guys will get a little bit better feel for how this works. Okay. All right. So this guy right here, this is the simulator that you have access to that you can go on and try this. So we're going to do a new simulation, and we're going to compare it to a new transaction, a primary residence purchase transaction. And we're going to do $1 million loan or $1 million purchase price with an $800,000 loan. And we're going to compare it to a conventional 30-year fixed rate. And right now we're a tad over 7% on the rates, but we're going to put in 7% for right now. So this is your monthly payment on your P&I, your principal and interest payment on a 30-year fixed rate loan. Okay. We could even put in here that you're going to put in an extra $50 a month if you wanted to. Right now, we're going to leave it at nothing, but we can put in and say you're going to put an extra $50 a month there. Your deposits. So this is your income. So let's just say that we have somebody that makes that takes home $12,000. Let's say it's $13,000 for somebody that's getting $1 million purchase, right? And that's a monthly, or we can set it up this way to where it is $6,500 every semi-monthly. So that's twice a month. So you get $13,000 in deposits every single month. That's $156,000 in annual deposits that go through your checking account. Okay. Of that $13,000, your traditional loan payment, say, costs you $5,300. You pay $1,200 in taxes and insurance. So your total of those two expenses is $6,400. So what I've been normally saying is, let's say that there's 15% of your income that is left over in your account. Okay. What we're going to do, so that's basically $1,900 that's left over in your account each month in your checking account. So if that was the case, on your traditional mortgage, you pay $1.9 million in total payments and interest on a 30-year fixed rate. And again, normally you refinance in 7 years and you start the process, the most expensive part of the process all over again, where you pay the most interest in the first 15 years. On the all-in-one loan, you're going to pay off your loan in 19.9 years. So just under 20 years, and you're going to save $180,000 on this particular example. Okay. So 20 years, you're going to pay it off 10 years faster. You're going to save $180,000 in interest. So let me give you, I'm going to go to this pay down summary. How would you like it if you had a house that you were selling right now, or that you wanted to sell, but you didn't want to give up your 3% mortgage rate? Okay. I am showing you right now that if you followed this plan, that your effective interest rate on this loan would be 2.386% on this mortgage, because of the amount of interest that you are paying on this loan. Okay. Your break even average interest rate is 9.6% on this loan. That's what the interest rate is today. And I'm saying that we're keeping that 9.6% for the life of the loan right now in this example. Okay. So you are still saving a ton of money by paying this loan off in 10 years earlier versus your normal 30-year fixed rate mortgage is 7%, which you're going to refinance in a year or so, and you're going to refinance it to a 5% mortgage, but you're still going to pay way more interest when you refinance that loan. Okay, so that's the pay down summary. I'm going to show you some of the things here. This is normally what we're at is a 3.5% margin. So right now, I just showed you 3.75 margin. We're at 3.5. And what I'm going to do is I change this to the historical average of the rates on the 1 year CMT Treasury, and I'm going to return to the results. So I'm going to change this. So remember, we were at 19 years. Now we're at 13.6 years. If the rates do go down, you save $733,000 on this loan. So keep in mind that this is it's an adjustable rate mortgage. And because it is an adjustable rate mortgage, you are not going to have to refinance that rate into a 30-year fixed. You're not going to have to refinance it in a year, 2 years, or 3 years. You keep this loan because the interest rates, like I said, are going to start to come down here. We're going to go into a recession. The Fed, in a year or so, they're going to have to start adjusting the rates down even further to stimulate the economy and get it going again. And the interest rates are going to go down. And so you'll pay this mortgage off in 13.6 years versus the 30 years that you had originally, that you're going to refinance in the next 7 years and start all over again on another 30-year fixed rate process. And you still have the equity available on this mortgage to write a check for a new car, to write a check for a car repair, to write a check for college costs, write a check for medical expenses, because at the end of 13.6 years, you're not going to owe anything on it if you follow the plan on this loan. So I'm going to go back and I'm going to use I'm going to go to the max rate on this because I want to show you this, and I want you to understand that if you went to the maximum rate on this mortgage, let's look at what the results would be. And I don't foresee this happening, but this is the worst case scenario, is that the rates go up to the maximum the month after you get the mortgage, and you're going to pay $3.2 million in interest, which is way more interest than on the 30-year fixed rate mortgage. You're still going to pay it off 2 years sooner. And this is the worst case scenario on this transaction. So at the end of the day, this is the tail end. The world is falling apart upside down, and you will pay way more interest on that loan. So I don't like showing that piece of it, but I mean, that is the risk. That is the only risk that you will have on this potential loan. And the numbers that I run these at are that they remain at the initial interest rates, and that's what that 19 years is that you get paid off, that you save $260,000. So I know that may have confused you guys a little bit more, but let's see, does anybody have any questions whatsoever? I don't see any other questions.
Can you hear me, Mike?
I can, yes.
Okay. Are there additional fees to be involved other than the loan costs for this program?
Yeah, so the fees to get this loan, it's a normal mortgage. So you're going to pay the normal title, escrow, notary, recording, lender fees. So nothing's going to change there. You will pay a $60 annual line of credit fee on the mortgage. So that is the only fee that you will incur. So if you have it for the full 60 or full 30 years, you're talking about $1,800 over 30 years that you would pay in additional fees if you had that line of credit.
One other question.
Mm-hmm.
I'm expecting a recession in the stock market to go down.
Yes.
So I have a lot of money in cash at the moment. The cash could be parked there, if I understand this correctly, and as a one-time thing, and accelerate the payoff even more if it was there for a couple of years. Is that right?
100%. So let's just say that you had $200,000 in your account and you put it in, let's say month 2, but I'm going to go in, like, let's say that you're thinking that the stock market's going to go down in 6 months. And so you take it out and you put it into your account in 6 months. Then we're going to go to these results and you pay it off in 10.8 years. But even if you put that $200,000 into that account, you would still have access to get to that money later on if you felt like you're through the recession, and then you could actually take the money out and put it back into the stock market if you wanted to. Does that answer your question?
Yeah, it does. So it's in the calculator. We have access to the calculator at this point.
Yeah, you can. So you can go in if you need some help on it. But basically, if you go to my website, you can go to, let's see, I'm going to show it to you. Let's go here, application right here. So if you go to cmghomeloans.com/my site, Mike-Wise, I'm going to put it in the chat to everybody. You can go there, and then once you go to there, in fact, I'll go a step further. Let's get to all-in-one. And so this will get you, yeah, this is where you want to be. So let me actually repaste that in there so that everybody has it. And this is so that's the site that you're going to go to. This is a little video that will it's a kind of a corny little video that they have on here that explains the product a little bit. And then what you would do is you would go down here to the bottom into this interactive simulator and put your information in there. And then at the end, you're going to hit save and share. You'll be able to save the information. And if you have any troubles whatsoever with it, then just feel free to give me a call, and I'd love to spend 5, 10 minutes, 15 minutes with you to go over your scenario with you. So once I'm able to, I will get this mortgage on one of my houses. This is perfect for people that have investment properties. I am looking at, in fact, I'm doing a refinance for somebody right now that has 3 rental properties. And because he has 3 rental properties, he's has some money set aside. Let's call it $100,000 set aside in case of an emergency if something happens, and he loses all 3 tenants, or has, big repairs that he has to do on the property. And he has a 3% mortgage rate on the investment properties right now. I'm telling him to refinance into this all-in-one loan and take that $100,000 and pay down his principal balance. And then when then he'll end up with 2 other mortgages that he has on his other properties. And he gets rental income on all 3 properties. So that rental income, I'm telling him to take that rental income and bring it into this checking account on a monthly basis, so that money sits there. So he gets, let's say that it's $2,000 per unit that he has on the 3 mortgages. So he gets $6,000 per month that goes towards his all-in-one. And then the other 2 have a regular 30-year fixed rate mortgage. You wait to pay those until the 10th, 11th, 12th of the month, because you're using the renter's money to pay down your mortgage on your all-in-one loan to pay less interest. And then, you write the checks to the mortgage company so that they get there on the 15th, and you're using all the days that you can in order to pay down the principal on that all-in-one loan to keep the interest payments down. So it's a great product for investment properties.
Hey, Mike, do you know if this account has the ability to do like auto bill pay?
Absolutely, 100%. Yes, it's the same thing as your normal checking account that you have today. It's 24/7 access, online banking, bill pay options, etc. Everything that you normally have on your current checking account. Any other questions? If you did not hear this whole thing, I will post this online. It'll take me a couple days to do this. It'll be on my YouTube channel. It's Mortgage Wise. And if you want to reach out to me directly and schedule a time to go over this, or you didn't see it and you feel like you want a one-on-one with me on it, then feel free to reach out to me, and I'd love to do that. So send me an email. My new email address is mwise@cmghomeloans.com. So if you want to do that, I'll type it in there, mwise@cmghomeloans.com. So if you want to email me and do that, that would be fantastic. I'd love to go through it with you. All right. I'm just under an hour here. So hopefully you guys learned a lot with this. And I am super, super excited to sell this product and to give it to people, because I do think that it is a great product to get to your financial goals way sooner than you normally would using a 30-year fixed rate payment. So like I said, give me a call, send me an email, and I would love to talk to you and more in detail on it. Have a great night, and we'll talk to you soon.
Thank you.
Uh-huh.